Here are 5 stocks that super investors are buying now in 2025. We've got Warren Buffett, Cathie Wood, Stanley Druckenmiller, Ray Dalio, and Bill Ackman. Let's get straight into the 5th stock. The 5th stock is a stock called Uber. You might be aware of it. So Bill Ackman, with his company Pershing Square, purchased Uber, a new position of 30 million shares, which accounted for a big portion of his portfolio, 18.5% in Q1 2025. Why? It was activist confidence in Uber's path to stronger profitability and market leadership. So it's an activist play. You can see right here from Yahoo Finance, billionaire Bill Ackman is loading up on Uber technology stock, should you? So it says Ackman's hedge fund bought 30 million shares in Uber. The billionaire likes Uber's business, management, and valuation. Said Uber could have multiple growth opportunities, but it also faces major uncertainties because of increasing competition. Self-driving, Tesla, might I add? You can see that Bill Ackman wrote earlier on in the year, he said, beginning in early 2025, we began acquiring a position in Uber. Today we own 30 million shares. He said, I've been a long-term customer and admirer of Uber beginning when Edward Norton showed me the app in its early days. While a great business, Uber suffered from erratic management. Since he joined the company in 2017, CEO has done a superb job in transforming the company into a highly profitable and cash-generative growth machine. We believe that Uber is one of the best managed and highest quality businesses in the world. Remarkably, it can still be purchased at a massive discount to intrinsic value. This favorable combination of attributes is extremely rare, particularly for a large cap company. We have more to share about our thinking on the company shortly. So basically, he likes the management and he thinks it's selling for a discount. So let's take a quick look at the stock. So let's just say on a PE ratio, price to earnings basis, it is low compared to the market. The market's average, I think, is around 25 or something, could be a bit higher, but Uber is 16.8, so pretty cheap. Price to free cash flow is 25. Got a lot of cash on the books, $6 billion. It is still a big company, $200 billion, so maybe not a lot of cash relative to the size of the company. And it's got hardly any debt, which I always like. You look at revenues and they've been doing so well. I mean, Uber, as we know, has just gotten bigger and bigger and bigger. It's just all around the world now. And the revenues show that 3.8 billion in 2016, 13 billion in 2019, 37 billion in 23, and right now it's sitting at 45 billion in revenue. But the net income tells a completely different story. They've been bobbing up and down with profitability. Bill Ackman, he said there was some bad management in there. They had a lot of years of big losses, particularly around the pandemic. And even before the pandemic, you know, they were losing a lot of money, which is kind of natural for these growth type companies. But now they've gone into more profitability in 24. And even the last 12 months, they've made a lot of profit, $12 billion. So that's why the P ratio is very attractive right now. And the question is, over the next 10 years, are they going to consistently make this type of profit, or is it going to be a bit of this type of story where it's negative profit, then a little bit of positive, then negative? Bill Ackman clearly thinks that now with good management, they're going to continue these type of profit numbers instead of these. Guys, let's go into stock 4, which is a stock Ray Dalio has been buying with his company Bridgewater Associates, and that is Nvidia, the largest company in the world, the company that has just taken over the stock market in a certain sense. $4 trillion company at the time of making this video. So recent buy, Bridgewater more than doubled Nvidia position to 600 million by mid 2025. Why? Is a deep conviction in Nvidia's dominance in AI hardware infrastructure. So yeah, it says on this article, Nvidia Corporation is among billionaire Ray Dalio's Bridgewater stock picks with huge upside potential. That's according to Nihar Gupta from CNBC. So you can get a bit of a feel for Nvidia's business model. They have key partners, TSMC, cloud service providers, of course, just love Nvidia's chips, AWS, Microsoft, Google, and that's perfect when your customers have a lot of money. That's what you want as a business guy, trust me. OEMs and system integrators like Dell, HP, and Lenovo, obviously, and then you have AI developers, OpenAI, Meta, Tesla, and Adobe. Again, some big money companies who are your clients. That's a really good thing. So their key activities are chip designs, obviously GPUs for gaming. That's one of the key things that made them big. And now the new thing that investors are loving and everyone's loving is the AI type chips. They also do software development and platform development for autonomous driving. So as you can see, in terms of revenue, they make most of their revenue from data centers, which is AI chips plus networking, which is 47 billion. So that's by far their most. And then the second is gaming, which is 11 plus billion. And then you've also got automotive and software and licensing. They basically do the best chips in the game. That's how to sum up them as a company. Let's take a look at the stock. Stock has just taken off like a rocket, as we all know, these past 10 years. There's not been too many better companies in the stock market than this one, which obviously as a value investor makes you a bit cautious. $4 trillion. $4 trillion. I remember when they first got to $1 trillion and everyone was like, whoa, who would have thought a company could get to $1 trillion? I think it was Apple who got there first, and now Nvidia's at $4 trillion. You know what that means when valuations are getting so high? It just means they've printed so much money. PE ratio is still very high, especially for a $4 trillion company. So PE ratio of 53. Obviously the reason the PE ratio is so high is because this is where everyone wants to buy. This is the stock that every man and his dog wants to buy. Every hedge fund, everyone with big money, even small money people like my friends want to buy this stock. So that's why it's so expensive right now on a PE ratio, even though it's so big. Revenue growth, obviously it's been growing like crazy, 40% over 10 years. That's compounded. That's why it's such a big company right now. So yeah, Ray Dalio, even at these prices, he is still buying. Let's move on to stock 3, which is Stanley Druckenmiller, and he's buying a stock called DocuSign. Recently, he initiated a new position for $100 million in Q1 2025 at an average price of $88 a share. Why? He's betting on the software as a service recovery and growth in e-signature adoption. So it's all just about signing things online. Pretty basic software as a service model focused on electronic agreements. Its core offering is the e-signature platform, which allows individuals and businesses to sign, send, and manage digital documents securely. Pretty basic. So his most revenue comes from recurring subscriptions, mainly from businesses of all sizes. Okay, quick look at the stock before we power through to the next stock Cathie Wood is buying. So DocuSign has had horrid 5 years. It's crashed from $300 a share in July 2021, basically at the peak of the mania, peak of the money printing, peak of the bull market, and been one of those tech companies that has suffered a lot, and it's down to $77. As you can see, if you look back even further, it's, had an up and down journey. So it had that great increase coming into 2021 and then a great decrease. So big question is, should we buy at the price of $77? It said he bought at $88 if I'm not mistaken. Yeah, $87 a share he bought. So right now we can even get at a cheaper price than what Stanley got in. Now this is a little bit of a value investor's dream in some sort of way. You have a PE ratio of just 14 in this market. That is cheap. Relatively small cap, if we're talking when it comes to the big money. It's small cap. You could say medium cap. So 15 billion market cap. And look, they've grown their revenue pretty consistently over the past 3 years at 10%. In the past 5 years, they've grown it at 23%. So hard to complain. And even price to free cash flow is fair at 17. Yeah, just look at this revenue. This revenue is amazing. Look at that. That's what every investor wants to see. 250 million, 2016. Then it went to 500 million just 2 years later. Then 980 million just 2 years after that. Then 2 billion after that. So it's grown consistently. Now it's at 3 billion. It's not doubling like it was in the past, yes, but it's still growing a lot. So very interesting. Let's take a look at profits. The reason why the stock is done poorly is because of this. This is profit we're looking at. Net income profit. So although revenue's grown a lot, profit has done poorly. Negative, 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 negative. All of this, and this is a big negative, minus 400 million, minus 200 million. So in this period, up until basically 2024, for 8 years, they were just losing money. And now, yeah, these past 2 years, they've started to show, hey, we're a software business. We actually know how to make money. And then they made 1 billion and 1.1 billion. So if they can consistently make $1 billion, they're going to get their money back in 16, 17 years time. And then if they can grow this number, this is a great stock to own. So I'm going to have to look deeper into this one. Like I'm really curious if they can hold, if they can grow this net income, this could be a steal of a company. So Stanley might be onto something. Let's see if Cathie Wood's onto something. We all know what type of investor she is. Her big stock, one of the big stocks she's buying is Tesla. Her company is obviously ARK Invest. Recent buy, ARK Innovation purchased 60,000 shares in mid-July 2025 of Tesla. Why? Continued confidence in Tesla's AI initiatives, Grok, and autonomous tech roadmap. So it says the ARK investment founder says there is a lot of pent-up demand for Tesla's vehicles. The big valuation unlock, in her view, is Tesla releasing robo-taxis across the country. She said, so I now think they're going to start seeding every state with robo-taxis and their full self-driving. According to our calculations, their robo-taxis will be safer in the fourth quarter than human drivers are. That's a massive idea. The fact that you can just have a car self-driving and it can work for you. Like, this is a huge industry. be, I think she said it was between $8 to $10 trillion a year, this robo-taxi industry. So if this is a thing, then say goodbye to Uber stock, Bill Ackman. But I don't know for sure what's going to happen. But if Tesla can get this robo-taxi thing up and going, it's going to make a lot of money for them. Yeah, I'm not going to lie to you. It's not the cheapest stock out there. It's not a value stock. You wouldn't say that. A traditional value stock. 180p ratio, 180 times the current earnings. So those earnings are going to need to grow by a lot to justify the current price of $316 a share. It's a market cap of $1 trillion right now, Tesla, and very volatile stock, as you can see, over the past 5 years. $360, then it dipped to $110, and now it's back up to that $320 mark. They've grown their revenue very well over the past 10 years though. 40% 10-year revenue growth, 30% 5-year, and 15% 3-year. So yeah, in order to justify the current price, they better keep growing their earnings. They better get those robo-taxis going. They better get the humanoid robots going. And who knows, with the weird, quirky genius of Elon Musk, they might just do it. But now it's time to see, great mate, not really mate, but great genius guy, Warren Buffett. What stock are you buying, Warren Buffett? Occidental. Oxy, it said, recent buy. Berkshire Hathaway added $35.7 million early 2025 in Oxy. Why? A strategic energy value play with upside from carbon capture innovations. So they said Warren Buffett's big investment in Oxy hinges on a few key beliefs. One is a strong position in the Permian Basin. Buffett sees Occidental's deep focus on the basin as a prolific US oil region as a major advantage. As one Reddit user aptly put, Warren views Oxy's substantial position in the Permian Basin as a highly attractive long-term opportunity. I've heard him talk about this before. He really likes the CEO, Vicky Holub, calling her approach exactly what he'd do. He said, under Vicky's leadership, Occidental is doing the right things. We particularly like its vast oil and gas holding and its leadership in carbon capture initiatives. Third reason was undervalued cash machine with carbon capture upside. Buffett considers Oxy a mispriced cash generator. Its valuation hovers around 13 to 17 times earnings, cheap for a company with strong earnings and free cash flow. So it says Buffett's logic is clear. High quality cash flow from US assets, disciplined management, undervalued entry with clever financing structures, and the carbon capture optionality. So yeah, this is basically a completely different numbers game to Tesla. P ratio is just 19, market cap 44 billion, and it's just a slow growing revenue company. 4% revenue growth over 10 years and 3% over 5 years. In the past 3 years, they've had a bit of a dip. So price wise, it's more of a stock that Warren Buffett would buy. Low PE, low price, and revenue growth is fairly low too. So it's just a big value play. Pays a bit of a dividend too of 2.2%. Holds a lot of cash as well. You can see that the revenue game is nothing to sort of be in awe of. They're consistent with their revenues. They grew it a lot up until 2022, and then the past few years they had that dip as we talked about earlier on. Net income has just been everywhere, obviously because we had that big oil scare in 2020 and they lost a lot of money then, and that's when oil stocks crashed. I remember reporting on that, making videos on that. I actually talked about buying oil stocks over here, which turned out to be a good thing. Even Buffett bought. And then they started coming back into profitability and have been somewhat profitable over the past 4 or 5 years. Personally, I can't say I'm against this investment, and I don't see oil going away anytime soon, even though people have been saying for ages that oil has no future. No, in the next 3, 5, 10 years, I believe we're still going to have a strong need for oil.